Hello everyone. Today I want to share with you 3 tips I wish I knew before I started training. I will be as brief as possible, so let's move on to the tips. The first tip I have for you is to trade small and win big. What I mean by this is that trading multiple but small positions is better than making a one big position and blowing up your account shortly afterwards. Tip number 2, do not use a stop loss. This could be controversial for some people. I never use a stop loss. To me, the stop loss is another tool that the broker uses to take out your position and, of course, your money. I never used it. Once I stopped using stop loss, I started seeing profits on my account, so forget about the stop loss. Tip number 3 is some advice on how to find the right broker, because even if you have the capital, even if you have the means to trade, you still need a legitimate broker to entrust your money with him, because there are a lot of scammers, and you must really watch out in order to not lose your money. Of course, those are just tips. I'm not telling you how to do things. If you don't agree with me, that is fine. I'm just sharing my personal experience, and I'm not telling you in any way to do the same thing. This is just an informative video. Now moving on to tip number 1. Trade small, win big. What does that mean? Well, I will show you a case, and I will compare what you do and what I do, and where is the difference. You're doing the following thing, or most people. Now, most people would risk a huge amounts of money, let's say 10 lots or even more. So they will, let's say, buy 10 lots, the price would increase, and they will take a profit of $100 in maybe a day, or maybe a few minutes or a few hours, and they will be really happy. They would say, oh man, I won $100, what will happen next? Maybe the market falls a little bit, and they decide to buy 20 lots, or risk 2 times as much. The market shoots up again, and they make $200. And they're really happy. They're willing to risk more to win more. So they're waiting for their next move. So the market shoots up, and they're saying, oh, the market is going up, the market is going up. Let's go and buy 30 lots, which is 3 times as much as our initial investment. And, this time, the market doesn't go up, it goes down. Here you're starting to worry a little bit. Oh, what is going on? When will the market go up? Well, no, the market, it doesn't go up, and it shoots downwards. And what happens? You get margin called. You lost everything. You lost your investment and the money that you previously won. Now, what do? We are basically in the same situation, but I buy 0.001 lots at a certain level. So I would buy a very small position. The market will go up, and I will take a small profit. So when the markets fall a little bit, I will buy maybe some more lots. But again, those lots will be very, very small. The investment will be very, very small. Each position will be very, very small every time. And the market will shoot up, and I'll gain this time maybe $10 or whatever. Those are just examples. So when the market goes up, I'm a human being, of course. I don't know where the market will go, so I will buy some more units, but this time, of course, the market will go against me, like it went against you previously. However, because I have such a small position, even if the market crashes, I will still have enough money to be able to continue making positions, and now I will be waiting for an opportunity to buy. By doing this, I will just average out my position, and instead of getting a margin call, I will continue making money in the future. So this is why I wanted to share with you on this part. Just take your current account and divide your current positions by 3 or 5 times or 10 times. You will not regret it, because this means less stress, you will be able to sleep better, and your account won't be in your head every single day. So let's move on to step number 2, or tip number 2. Do not use a stop loss. I never ever use a stop loss in my strategy. When I was a beginner, I was told to use stop loss by who? By the broker, of course, because those people want to take your money. In order to protect my capital. However, I quickly realized that this is another tool given by the broker so that he can take your money more easily. Stop loss does not protect your capital. You can protect your capital just by making small positions or following the logic in tip number 1. I don't use any stop loss because I don't have to. I'm not using big positions, and therefore I don't need a stop loss because my account won't get blown up if I make a mistake. So now, here is this picture that here's this case that I gave you. I'm sure that you've heard this advice, I guess, that, there's a 50-50 chance that the market will go up or it will go down. There are just basically two options, up or down. So yes, there is a 50% chance that you will win, and there is a 50% chance that you will lose. Okay, that is a valid point. And some gurus out there say that you should risk. This is your risk level or your R level. So with each entry, you should put a stop loss that is equal to this risk level. It could be in pips. Let's just say 25 pips or 50 pips, or in euros, 5 or dollars, $5, $10, whatever. And to counter this, you should put a 2R as your take profit level, which basically means that you are expecting to return twice as much as you're going to lose over the long period of time. However, here is the equation. So here you have 0.5 or 50% multiplied by 2R minus 0.5 multiplied by R, by just R, your risk level, and this gives you a 0.5 R, which is your quote profit, margin. But looking at this, I'm not convinced. I'm not convinced about this, because seeing these percentages right here and these levels right here, I'm seeing the following thing. 2R plus R gives you 3R, correct? So if you divide 100% by 3R, or just by 3, that gives you 33%, more or less. So basically, the way I'm looking at this, it's a bit inverse, it's a bit inverted, but to me, you have a 66% chance of hitting your stop loss level, because your TP level is 2 times apart as your stop loss level. For instance, when you enter a position, you choose a R of 25 pips. If the price falls just 25 pips, your position will be closed. But in order to win from this position, you need 50 pips, which is 2 times as much in order to trigger your take profit level. So there is no positive expectancy from this system. So I never trade it. Furthermore, there's always one but. The broker almost never tells you. I mean, they do tell you, but they put this information in very small script in their contract. And they can legally change the spread of each of their instrument, and this can trigger your stop loss level. Now, what is a spread? Spread is basically a difference of price. Let's say if the real price of an instrument is $1, there is a broker price associated to this instrument, and it usually is lower in the case of a buy example. So if the real price of an instrument, it could be a forex pair or oil or gold or whatever. If the real price of an instrument is $1, the broker price of the same instrument will be $0.9. So if you want to buy this instrument, you will buy it at $0.9 and not $1. So that means that there is a spread or a difference of price of $0.1 or 10 cents. The spread is generally 3 to 30 or more pips or cents, if you like, depending on the instrument. So that is why each time you make a buy position, you always begin in the red. So what happens with this spread? This spread level can be legally changed by the broker at any given time, because most of the brokers nowadays are market makers. So they can legally change this spread level. So what happens is, here is a small animation that I make. They can legally change their price just enough in order to hit your stop loss level. And this, to me, is the reason that I am never going to use a stop loss level, just because of this situation. Just make smaller positions, don't make big positions, and small positions do not require a tight stop loss. Have you ever heard the phrase, Warren Buffett has bought 1 million worth of stock and he has put 20 pips, and he has put a tight stop loss of 20 pips below the price? I mean, of course you have heard that. It's a famous quote. Whatever. Let's move on to the step number 3. Finding the right broker. As some of you might know, I am using the services of the Owanda broker. This broker is based in Canada, but they have multiple trading centers in Canada, in Europe, and I believe in Asia. I'm not sure, but you can Google that. So what did I do before investing with Owanda, and what are the steps that you should take to assure that the broker of your choosing is not a complete scammer? First of all, study their history. Old brokers, brokers with a lot of experience on the market, are less likely to be scammers than brokers that just came on the market and they boast about their winnings. Owanda was founded, I believe, in 1997 or something like that. Of course, you can Google that. And they're still on the market, so since 20 or so years. So Owanda is an old broker, an established broker, so that checks out for me. Call them. Most brokers don't hide their information. There are phones available, contact information, mail information. Just call them and ask them, hello, I'm willing to invest with you. What is your organization? Could you please tell me this and that? Just to check out their tone. I personally called Awanda several times. They called me back as well. We discussed some financial things. Visit their office. Again, most well-known brokers have multiple offices, agencies, and so on all around the world. I personally never went to a Wanda office because I'm living in Europe and the office is in the UK, and I'm not living in the UK, so I don't have the time to go there. But I don't see any problem with. I'm talking about Wanda because that is my broker and that is my experience. There are many good brokers out there, and I'm not obliging you in any way to choose Wanda. I'm just telling you. Again, my personal experience. You can apply the same rules that you see here to another broker, and if they check out, well, you can invest with them. The next step is to check the regulatory and financial compliance documents. This is a quite important thing. You must check those documents on the site of the broker, and you must really see who and how regulates the broker. Check their tone when it comes to investing. If they try to lure you into some no risk, high reward scheme, just don't go. Just say okay, and just leave the broker. This broker is most likely a scammer that is just willing to take your money. Trading is very risky. Your capital is always at risk, and you can use everything. So, last but definitely not least, pay very close attention to Cyprus, Panama, and Belize-based organizations or brokers. These brokers are regulated, but specifically in those countries, the regulation laws are basically non-existent. So I'm not saying that all the bad brokers are located in Cyprus, Panama, and Belize, but they pay very close attention to these brokers or organizations that are located in these countries, because those countries are financial heavens for scammers. Press the like button if you like this video, comment if you have any questions, remarks, and subscribe to my channel if you like my content. Have a nice weekend, and I'll see you next time.